Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. This is a video gold market commentary for May 18th, 2022. For the last 24 years, we've delivered our gold market commentary quarterly in a written format. Over the last several months, however, events have transpired so quickly that by the time we got something written, markets had moved so much and it became obsolete. So we're going to go to the video format like we are today in an effort to be a bit more nimble and reactionary to what's happening in the marketplace. We may not be able to go into the types of deep dives that we've done in the past, but if we produce these a bit more frequently, we'll still be able to give you quality information that'll help you make informative and intelligent decisions in the precious metals arena. So I'd like to share my screen with you now, if I may, and start my presentation. So we're American Gold Exchange. We're a national mail order dealer out of Austin, Texas. This is our website, www.amergold.com. We offer very competitive and transparent live pricing on modern bullion items, the most popular ones, and also on vintage pre-1933 US gold coins, as well as European gold coins pre-World War II. We're very user-friendly. We are consultative in nature, so we're trying to help you determine what is best for you and find those products that may help you the best for whatever your needs are. We're very user-friendly. If we can help you, we'd love to have that opportunity. So here's our gold market commentary for May 18th, 2022. Precious metals are finding support following the everything sell-off all markets have been going through over the last 6 to 8 weeks. The US dollar is exceptionally strong for now, which is helping to pressure gold. Inflation, however, continues to be red hot. We'll look at the Fed funds rate from back in the 70s and 80s and compare it to today's Fed funds rate. We'll look at updated gold, silver, platinum, and palladium charts. We'll talk about the physical precious metals arena. Specifically, the silver squeeze is easing a bit. Prices are edging a bit lower, which is good news. And we've got two $20 Liberty specials today, which we think offer exceptionally good value in the current marketplace, which is what one of our jobs is, to help you find those good values. So let's look at the dollar. As you can see, the dollar has been in a big U formation for the last 2 years. It bottomed during 2021, in early 2021, and again in the summer, and it's moved higher since the Fed first floated the fact that they might start to taper last June. Dollar moved up steadily since then, and we enjoyed really good GDP in 2021, 5.7% on an annual basis, which is the hottest GDP we've had since 1987, I believe. And then the dollar has been goosed higher on first blush by the Fed rate hikes in April, and again in actually late March, and again in May, of a quarter point and then a half a point, as the Fed goes into the strongest tightening cycle we have seen in 40 years to combat inflation. But the current dollar move looks more to us like an abnormal flight to safety spike than a fundamentally value-driven rise, because our GDP in the first quarter of this year was negative 1.4%. So it's unusual for the dollar to be so strong when our GDP is weakening and the US economy is weakening, especially compared to last year's exceptionally strong GDP, which we think was goosed more by stimulus money than anything else. So the spike that the dollar's going through is just that, a spike, which we don't think will hold. And this is why. If you look back to 2000 and look at what the dollar's done since then, it becomes pretty apparent that the dollar's had a couple of big spikes as flights to safety when there were sell-offs in almost all markets, and the world went to cash, so they wouldn't be holding a falling knife. like stocks have been over the last couple of months, and crypto's been affected too. So we had a big spike in the dollar as a result of the great financial crisis in 2008. That's that first blue line. The dollar legitimately gained traction in 2014 and 2015, as indicated by that red oval at that time, because the US economy rebounded the best from the great financial crisis in 2014 and 2015. We got the most traction and we grew the fastest for a while, which helped to buoy the dollar back into more moderate range compared especially to the euro and the yen and the Swiss franc. We had a bit of a spike during the 2016 presidential cycle and when Donald Trump became president, because he was pro-business and deregulatory. That was potentially a good sign for the US economy being able to be a bit more efficient. Didn't prove to be the case on the dollar chart, but the dollar held up above the low of 88 during that time, which was the resistance level prior to that on the index chart. And we've had a COVID spike in the dollar, which didn't hold. That was another rush to liquidity in March and April of 2020. As you can see it, the dollar spiked up to a high of about 103.6 on the dollar index chart, but it didn't hold. And now we're going through a similar very sharp spike higher when US GDP is actually negative, which is very unusual, which is why we don't think that this dollar strength will last. And the dollar and gold tend to trade inversely. So as the dollar gets stronger, gold tends to go lower in price because most of the people that buy gold in the world are outside of the US. And if gold is priced in dollars, gold becomes more expensive in other currencies, which is why when one's strong, the dollar strong, gold tends to get pressured. And we don't think that this dollar spike will hold for very much longer. In fact, we think it's peaking now, which is a good news for gold and silver. As always, time will tell, of course. Let's look at inflation. Well, let's talk about the dollar for just another minute or two. We think the dollar could edge back down into the 100 to 102 range, weaken a bit. And it depends how the US economy does. We think we're headed towards a recession, and we don't think it'll be a soft landing, because anytime the Fed goes through a rate hike cycle of 2 or 3 points or more, we tend to have a hard landing, not a soft landing. That's the historical result. Let's look at inflation now. This is an inflation chart going back to 2000. As you can see, we're as high as we've been on this chart this entire last 22 years at 8.5% inflation in March and 8.3% inflation in April. In fact, we're back to 1970s level of inflation. And we haven't seen this kind of inflation for 40 years. So most people under 55 don't remember what it's like to be in an inflationary cycle. I do. I was a teenager and a young adult in the 70s and early 80s, and I lived it. It wasn't fun. And we're in another one of those periods right now. In fact, let's take a look at inflation going back to 1957. We had a major spike in 1973 that was primarily driven by an Arab oil embargo. Then inflation abated back from about 12% to about 6%. And then in the second half of the 70s, it rocketed higher to over 15%. And that's when the Fed got very aggressive with the Fed funds rate, and they killed inflation, but it was very painful to do so. Once they did so, inflation didn't get back over 6% until now. It didn't even quite get there during the great financial crisis. So if you look at where we are today, we are back into 70s level inflation here. Now, we're not at the extremes yet. We could get there. We may not. It's hard to say. But inflation has been persistent. It's not transitory. And it's pretty well embedded into our economy right now. And it's going to be hard for the Fed to fight this. And this is why. Back in the 70s, the Fed funds rate got into double digits multiple times. They raised the Fed funds rate to almost 13% in 1973, which helped to bring inflation back down from about the same level. And then during the second half of the 70s, when inflation went from about 6% to 15%, the Fed funds rate got to 17.61%, but that didn't kill inflation. They thought it did, so they dropped the rate to 9%, but they ultimately had to bring it up to 19% twice to ultimately kill inflation. This is what killed inflation. This is demand destruction at its most fundamental level. And what many of you should know is that Paul Volcker became Fed chairman in 1979, in June or July of 79, when inflation was 7.5%. He raised the Fed funds rate 10% in less than 6 months. Now, what kind of destruction would that do to the economies of the world if that were to happen today? It's impossible. We're in a different world today. At that point in time, we were a creditor nation, the world's biggest creditor nation. And most of our debt was in long-term treasuries, 20 years and 30 years. Today, we're the world's largest debtor nation, and most of our debt is in short-term treasuries. So the interest that we will pay will be dramatically affected by much higher Fed funds rates through our treasury bills than it was back in the 70s, when most of the treasuries were much longer duration in the marketplace. So we don't think the Fed has the kind of ability to react dramatically like they did in the 70s. So let's take a look at the chart of the Fed funds rate going back to 2000. As you can see, the highest the Fed's fund rate has been this entire 22 years is 6.5%. The lowest was 0.16%. This is the era of easy, cheap money, and that's drawing to a close today. Excuse me. Coincidentally, the highest Fed funds rate in the last 12 or 13 years is 2.5%. This is lower than the lowest Fed funds rate between 1970 and 1995. Today, it remains an anemic 0.88% against an inflation rate of 8.5%. We think that the Fed will be able to get the Fed funds rate up to maybe 3% this year, maybe 3.25%, 3.5% if they're really aggressive. And if inflation stays at 6, 7, and 8%, the Fed will continue to remain decidedly behind the curve, which is why we think it's vital that you have precious metals in your portfolio, because they tend to hold their purchasing power better than almost anything that's an alternative in the world. However, gold and silver on sale. Let's answer the questions most of you have. Why have they skidded lower in the last few months? Well, we've got inflation like we haven't seen in 40 years. And most markets don't know how to react to this because we haven't seen it for such a long time. The Fed's tightening cycle and their jawboning has created volatility in all markets. Stocks are reacting very badly. They're selling off sharply. Today, by coincidence, it's May 18th, the Dow closed down over 1,000 points. Now, as we've seen the Dow skid over the last 4 or 5 weeks, gold has been weak with the Dow because it's been a flight to safety. Everything's getting sold. It's like they're throwing the baby out with the bathwater when gold gets cheaper in this environment, but that's what tends to happen. Today, however, gold actually went up a little bit, $10, when the stock market fell 1,000, which is why we may be seeing a decoupling of this correlation, which we've been watching for the last 5 to 6 weeks. So we said the dollar is abnormally strong despite the US economy slowing. We just went through that in depth. What's very hard to measure are the China COVID shutdowns. There have been major cities have been shut down for a month to 2 to 3 months in China, which has been a drag on their economy and a drag on demand for everything, including precious metals, and they're big precious metals buyers. So we think that this has been a contributing factor to the gold and silver skid, but it's very hard to measure to what degree. The war premium has gone out of gold in the Ukraine. The war is still raging, sadly, and it's going to continue for quite a while. And it's deeply inflationary for several reasons. Russian sanctions on oil. Russia's the #1 oil exporter in the world. The inability of the Ukraine to deliver wheat and corn. They're the #3 wheat and corn exporters. We could see oil go a lot higher still over $100 a barrel, which it is today. I just paid $5 a gallon for gas for the first time in my life yesterday. And food prices are going to go higher. So inflation's not going to ease easily, and the Fed's going to be behind the curve, and the war premium has gone out of the gold price. So that's a reason why we think gold is fundamentally cheap at these levels, and gold is finding support today at $1,800, which is a good sign. It's holding 1,800, which could be the bottom of this cycle. Is it? Potentially. Let's look at the charts. This is a 2-year gold chart going back to May 17th of 2020. For those of you that have followed our written reports, we like to put labels on major events and when we put out our gold market alerts. But this chart's pretty busy with all the labels on it. So let's look at a cleaner chart, which is a bit simpler for you to see. This is the 2-year gold chart. For most of the past 2 years, gold is traded between 1755, the low red and green support resistance level on the chart, and 1925, which is the high red and green support and resistance level on the chart, with a pivot point at about 1835. Today, we're in the lower half of these two major support and resistance areas, with two surges dramatically over the high of 1925, first in reaction to COVID and second in reaction to the Ukrainian war. And now, as we said, we've seen that war premium skid back out of the gold price. With the dollar potentially weakening from here, inflation continuing to be persistent, and the Fed raising, we actually think gold could follow the Fed funds rate and treasury rates higher if that's what happens, because they did in the 70s. Gold actually can rise with the higher Fed funds rate. It did dramatically in both of those two inflationary bouts in the early 70s and the late 70s. So gold has really explosive upside potential with not much downside risk here. We especially like gold under the 200-day moving average, which is the red line on this chart at about 1830. Could gold get a little weaker? Yes. We could see it skid to support at 1755. If that happens, we would really be attracted to it, but we think the whole world will be too in this environment as a safe haven from currency destruction, which is what inflation is. Remember, gold tends to hold its purchasing power better than just about any alternative investment vehicle there is, absent land and real estate. That's really the only competitor that gold and silver have as far as holding purchasing power. So we like gold at these levels. We think most of the liability is out of the gold market, with gold at about 1815 today. We do think it still has a little bit of downside risk, but not much compared to what its upside potential could seriously be over the next 6 months to 2 years. And we do not think that the US economy will fare very well in the kind of a cycle that we're in for a host of reasons: a higher Fed funds rate, weakening dollar, and the fact that we're on the cusp of a recession already. We think we're headed for a hard landing. Let's look at silver. The silver chart is similar, with a surge higher following COVID, then a period of some trading between two major trading ranges of support and resistance at 23, major support at 23, with resistance at 2750. We've had to add a support line at the bottom of the current trading levels at 2150, because that's where we're at today. So silver has sold off more sharply than gold during this period of weakness that we've been going through, which is not unusual. Silver tends to oscillate at a wider range than gold does when we hit market extremes, both high and low. And we think we're hitting one of those extremes now. Silver is holding support at about 2150, where that low green and red resistance and support line is, but it still could ebb a little bit lower. The red oval at the left of the chart shows where silver blew straight up from 1950 to 2250 on a bullet when COVID caused it to break out sharply. We may see silver backfill into that area a bit more before it fundamentally rises again. but we do like silver at these levels. We think it's oversold. It still could get a little bit cheaper, but it's got really sharp upside potential. It tends to be more volatile, as I said. We like it under 2150. We especially like it under 23 fundamentally. If it gets under 20, we think the whole world will like it. Under 20, we think the whole world will like it. So if that opportunity exists, it won't last very long. So we like silver at these numbers. The gold to silver ratio is about 85-1 today, which means it's cheap relative to gold. Anything when the ratio is 80-1 or higher means silver is really cheap relative to gold, and it's about 85-1 today, which means silver is a better buy than gold. Buy a couple dollars an ounce in silver. So we like silver at these numbers. Platinum and palladium are a bit different. They're more industrial use than commodity and currency, which silver and gold both enjoy both of those. Platinum and palladium are more commodity related. Platinum is primarily used in diesel automobile catalytic converters. And we have not seen the kind of demand for platinum since the VW diesel scandal of 2016. It's traded at a major discount to gold ever since then, which is unusual for its 30 to 40-year price history. We saw a bit of a platinum spike when Russia invaded the Ukraine, because Russia provides the world with about 50% of the annual available supply of platinum. But that spike did not hold. It skidded a bit down to under 950, which is cheap, but it's hard for platinum to hold gains in the last 5 to 6 years since the VW diesel scandal. So while we like platinum, we think it has a lot of potential upside opportunity. It's going to be a bit of a longer hold if you decide to invest in platinum. It is cheaper in its cycle right now. If it were to get under $900 an ounce, we would really like it at that number. It's not really that far from that, but we're having a hard time seeing why platinum should go higher in the short term, especially compared to gold or silver and palladium. Let's look at palladium. Palladium has been the most profitable precious metal over the last 6 or 7 years. It's much scarcer than platinum. 5 to 10 times scarcer than platinum, and platinum is about 20 times scarcer than gold in the ground. Again, Russia is a major supplier of palladium. It's a byproduct of producing platinum. And when Russia invaded the Ukraine, the palladium price spiked about $500. Well, now we've given up that and a lot more so. In this recent sell-off, palladium has gone under $2,000 an ounce, which is about where it is right now, 2,000. It got as low as 1860, which is a double bottom on this chart, absent that unusual December spike lower at 1550. Palladium has a lot of upside, but it also has risk on the downside at current levels. So we do think fundamentally, as use in gasoline catalytic converters, palladium is fundamentally a good long-term investment. Plus, it's used in hydrogen fuel cells, and it's scarce. And it may get scarcer because of Russian sanctions. So we like palladium, but it's hard to buy in the current market. We'll talk about that just in a second. So the pivot point for palladium is about 2,200. It's under that right now. Major support is at 1775. We're in the middle of those two support and resistance levels. Its trend is lower right now. We'd like to see it rebound and hold over 2,000 before we were really comfortable that it has ended its attrition period that it's been going through. But then we'll lose a little bit of opportunity. So there's more opportunity in palladium, but there's also more risk. In the physical precious metals arena, physical demand has been really strong since COVID erupted in March of 2020, but it's eased a bit over the last 6 to 8 weeks. So what we're seeing are lower premiums for silver in particular, and an easing of delivery delays, while gold has not been near as affected during the squeeze we've gone through in silver. So premiums for gold bullion items remain normal, and delivery times remain normal, except for the Royal Canadian Mint gold maple leafs, which are in delayed delivery and a bit higher premium than normal, which is very unusual. The Royal Canadian Mint is normally a very reliable producer of bullion products, but maple leafs are behind right now and the premium's up a little bit. So that's unusual. The good news is the silver squeeze is easing a bit and premiums are easing lower, especially for sovereign minted products like the Australian Philharmonics and British Britannias. We've been able to drop our price 50 cents in the last week or two, which is good news. And the delays are easing as well. We used to have delays of 4 and 5 weeks for physical delivery of these products. Now we're about 2 weeks out, which is more logistics than anything else. Platinum availability is still inconsistent. You can buy platinum bars. You can buy platinum eagles that the US Mint makes, although the US Mint tends to burp them out in 2 tranches a year, once in January, again in the summertime. We're between those right now. So premiums are up a bit and availability is spotty. And the Royal Canadian Mint is not producing platinum maple leafs, nor are they producing palladium maple leafs. So the Royal Canadian Mint's really having some issues right now, which is very unusual. If you want to buy palladium, physical palladium is hard to get right now. So that's the conundrum with palladium. The good news is, as we said, the silver squeeze is easing a bit. This quieter period that we're going through is allowing the mints to play a bit of catch up with demand down. So that's good. Hopefully that will continue. In the pre-1933 US gold arena, we particularly like the $20 Liberty and MS63 today for someone who wants to own private, non-reportable gold and have some good upside potential due to scarcity. The MS63 is a good conservative buy, especially when you compare it to an MS64 Saint. The $20 Liberty is about twice as scarce in known population. It's priced $70 lower today, and it's got a $400 higher previous market high. Priced at $21.30 today on special, it's a great value for people that want to buy conservative, private, non-reportable US gold coins. For speculators who want to have a bit higher upside potential, the $20 Liberty and MS64 is really a superb buy today. When you compare it to the MS65 St. Gaudens, again, it's about twice as scarce, trading for a lower price, $50 lower. This is the best news. It's got a $1,030 better previous market high than the MS65 $20 St. Gaudens, which is a more popular coin. But both of these $20 Liberties in choice uncirculated MS63 and near gem MS64 condition are superb buys for the conservative investor or the more speculative investor. We have them on special today. We really like them at these numbers. Additionally, on our website, we produce premium and price charts that show how these coins have traded relative to their intrinsic gold content since 1998. We're the only company that publishes this information. And this is one of our primary analytical tools that we use to find good value in the current market, which is one of the ways we can fundamentally help you make better investing decisions in the pre-1933 US gold coin arena. It's one of the ways we try to help you through education and information make intelligent choices. So again, here's our contact information. I would like to thank you for your time today and thank you for your support. We wouldn't enjoy the good business that we enjoy without your repeat business and the referrals that you give us. It means an awful lot to us. We hope that we can help you in this marketplace in the future. And if we can, please give us that call or send us that email. We'd love to help you. So thank you and good luck out there.